If you're over 40 and feeling behind on investing, you're not late. You're just getting advice designed for 25-year-olds that doesn't work for your timeline anymore. Here's what nobody tells you. What builds wealth at 25 can destroy it at 45. The rules change the day you turned 40. Your time horizon is different. Your risk tolerance should be different. Your entire strategy needs to be different. But financial advisors, they're still giving you the same cookie-cutter advice they give everyone. And there are 7 specific truths they won't tell you. Not because they're hiding them, but because these truths don't benefit their business model. Truth number 7 contradicts everything you've been told about retirement accounts and could save you 6 figures in taxes. If you're over 40 and want real talk instead of sales pitches, hit subscribe right now. Drop your age in the comments if you're starting or restarting after 40. Let's start with truth number 1, and this is why your 25-year-old coworker's investment strategy will absolutely bankrupt you. Truth number 1 destroys the most dangerous assumption in investing, that age doesn't matter when it comes to risk. Financial advisors will tell you, invest aggressively. You have time to recover from crashes. That's fantastic advice if you're 25 with 40 years ahead. It's catastrophic advice if you're 45 with 20 years until retirement. Here's what they won't tell you. Time horizon isn't just a number, it's everything. It determines how much risk you can stomach, how much volatility you can survive, and whether a market crash is a buying opportunity or a retirement-destroying catastrophe. The standard advice is, stay 100% in stocks until 50, then slowly shift to bonds. Ride out the volatility. Markets always recover. And yes, historically, markets do recover. But that advice assumes you have decades to wait. At 25, you can ride out the 2008 crash and recover by 2013. At 55, planning to retire at 65, that same crash obliterates your timeline. This is called sequence of returns risk, and it's the silent killer of retirement plans. Here's how it works. 2 investors, same contributions, same average returns over 30 years. One experiences crashes early in their career, the other experiences crashes near retirement. Same average return, completely different outcomes. The person who gets hit with a 40% crash at age 58 never recovers before they need the money. Their retirement is destroyed not by bad investing, but by bad timing they couldn't control. You can't afford to gamble on timing at 45. You don't have 15 years to wait for the market to recover, as you did at 25. The real strategy after 40 shifts focuses. You need growth with protection, not maximum returns, sustainable returns that won't blow up your retirement if the market crashes at the wrong time. Here's what actually works. Age 40-50, shift to 60% stocks and 40% bonds, cash. Age 50 to 60, move to 50-50. I know, that sounds conservative and boring. Good. Boring is what keeps you from eating cat food at 72, because the market crashed when you were 62 and wiped out half your retirement. Let me show you 2 investors, both 50, both starting with $200,000 saved. Investor A follows aggressive advice, 100% stocks. Market crashes 40% when he's 58. His $400,000 becomes $240,000. He needs 5 years to recover. He's 63 before he's back to even. Retires at 65 with barely more than he had at 58, devastated. Investor B takes the boring route, 60% stocks, 40% bonds. Same crash hits when he's 58. His portfolio drops only 20% because bonds cushion the blow. His $400,000 becomes $320,000. Recovers in 2 years, retires at 65 with $480,000. Comfortable. Same starting point, same timeline. Different risk allocation. One followed the 25-year-old advice and got destroyed. One adjusted for his actual timeline and retired in peace. At 25, time heals investing mistakes. At 45, mistakes are permanent because time is the one resource you can't buy back. Adjust your risk accordingly or pay the price when it's too late to recover. Your time horizon demands different risk management. But truth 2 shows what most people get wrong about the single biggest retirement account decision you'll make in your 40s. Truth number 2 is the tax strategy financial advisors barely mention because it doesn't benefit them. Converting your traditional IRA or 401k to a Roth right now in your 40s and 50s is probably the smartest tax move you'll ever make. But you won't hear this pushed hard because it doesn't generate ongoing advisory fees. Here's what they're not emphasizing. Tax rates right now are historically low. The 2017 tax cuts expire in 2025. Rates are likely go up. You're in your peak earning years, yes, which means higher bracket, but you're also still working, which means you can absorb the tax hit without touching retirement funds. This is your window. After retirement, you're facing required minimum distributions starting at age 73. The government forces you to withdraw money from traditional accounts, whether you need it or not, and every dollar is taxed as ordinary income. Those RMDs could push you into a higher tax bracket in retirement than you're in now. So much for you'll be in a lower bracket when you retire. Here's the Roth conversion strategy. Take money from your traditional IRA or 401k and convert it to Roth. You pay taxes on the conversion now at today's rates. Then it grows tax-free forever and comes out tax-free in retirement. No RMDs, no forced withdrawals, no taxes ever again on that money. The math is compelling. Let's say you have $100,000 in a traditional IRA. Leave it traditional, it grows to $200,000 by retirement. You withdraw it, pay taxes at potentially 25 to 30% future rates, and you net maybe $140,000 to $150,000 usable. Or convert that $100,000 to Roth today. Pay $22,000 in taxes now at 22% bracket. The remaining $78,000 grows to $156,000 in 20 years. But here's the key. That entire $156,000 is yours tax-free. No taxes at withdrawal. Plus, it keeps growing tax-free as long as you want because there are no RMDs on Roth accounts. But wait, it gets better. Roth accounts pass to heirs tax-free. Do your kids inherit a traditional IRA? They pay taxes on every withdrawal. They inherit a Roth, tax-free inheritance. You're creating generational wealth, not a generational tax burden. So why don't financial advisors push this hard? Because conversions don't generate ongoing fees for them. It's tax planning work, extra effort for them, and it temporarily reduces the account balance they charge fees on since you're paying taxes. It benefits you massively, he stressed. Benefits them minimally, so they mention it politely and move on. The strategy is to do partial conversions over multiple years. Don't convert everything at once and spike into a higher bracket. Convert just enough each year to fill up your current tax bracket. Stay at 22%. Convert enough to stay in 22%, not push into 24%. Let me show you a real example. A couple in their late 40s with $300,000 in a traditional 401k. They convert $30,000 annually for 10 years. Staying in the 22% tax bracket, they pay roughly $66,000 in taxes over the decade. Painful in the moment, yes, but at age 65, their entire $450,000 Roth balance, original $300K plus growth, is withdrawable completely tax-free. They saved over $100,000 in taxes compared to traditional withdrawals. Plus, no RMDs means they control when and how much they withdraw based on their needs, not the government's rules. Pay taxes at known rates today versus unknown higher rates tomorrow. Your future self and your heirs will thank you for converting to Roth while you had the chance. Roth conversions optimize your tax strategy for the long game. But Truth 3 destroys the myth that's keeping people from actually building investable wealth. Truth number 3 destroys the dangerous fantasy keeping people from actually investing. My house will fund my retirement. I'll just sell it, downsize, and live off the equity. Financial advisors hear this constantly and rarely push back hard enough because as long as you're not selling your house yet, you're still investing with them. Here's the brutal reality they won't emphasize. Your house is a trap masquerading as a retirement plan. Let's walk through what actually happens when you try to use your house for retirement. You've got a $500,000 house paid off. Feels like wealth, right? You're going to sell it, downsize to a $350,000 house, and pocket the difference. Sounds perfect on paper. Reality, you sell for $500,000. Realtor takes 6%. That's $30,000 gone immediately. Closing costs, moving expenses, and another $10,000. You're down to $460,000. Buy the smaller house for $350,000. After all costs, you've netted maybe $100,000 to $110,000 in actual usable cash. That money needs to last 20 to 30 years of retirement. That's $3,300 to $5,500 annually. That's not a retirement plan. That's a small supplemental income that you paid dearly for in stress, moving trauma, and leaving a home you probably loved. Oh, and here's the part nobody mentions. You still need somewhere to live. Downsizing doesn't eliminate housing costs. Smaller houses aren't proportionally cheaper. You're still paying property taxes, insurance, maintenance, and utilities. You just traded a house you knew for a house you're learning, and you're older now, so every repair is harder. The real costs of houses that destroy the equity retirement plan. Property taxes rise every year. Homeowners insurance is skyrocketing. Maintenance doesn't stop. Roof, HVAC, plumbing, all of it ages and fails. At 70, you're paying $800 monthly just in taxes and insurance on a paid-off house. That's $9,600 annually before you fix a single thing. Here's what financial advisors won't say directly. Your house equity is trapped unless you're willing to sell and uproot your entire life. And selling destroys your stability at the exact moment you need stability most. What actually works? Your house is a shelter, not an investment. The strategy is, pay it off completely before retiring, so you eliminate the mortgage payment. Then keep living in it. Don't count on selling it. Instead, invest separate money for retirement income so you're not dependent on your house equity. The math that works. Pay off house by age 60. No mortgage payment means you need less retirement income. If your paid-off house costs $12,000 annually in taxes, insurance, maintenance, that's way less than the $24,000 plus you'd pay in mortgage, plus those costs. Your retirement income requirement just dropped significantly. Let me show you what happens in real life. A couple retired with $400,000 in house equity and only $100,000 actually invested. Thought they'd sell the house to fund retirement. Got to retirement and realized, where would they live? Rent at $2,000 per month? That's $24,000 annually burning through cash. Buy smaller? Still expensive, and they'd lose $40,000 in transaction costs. Worse, emotional attachment. That house is where they raised their kids. 30 years of memories. The thought of leaving was devastating. They were stuck. Needed the money but couldn't emotionally or practically afford to sell. They should have focused on investing more in their 40s and 50s instead of counting on house equity. Now they're house rich and cash poor with limited options. Your house keeps you warm and dry. Your investments keep you fed and free. Don't confuse shelter with a retirement strategy. One protects you from the weather, the other protects you from poverty. Your house is shelter, not an ATM. But Truth 4 reveals what actually generates the retirement income you'll desperately need. Truth number 4 contradicts what every advisor pushing total return wants you to believe. After 40, dividend-paying stocks are more valuable than growth stocks. Not because growth is bad, but because you need income in 15 to 20 years, not just a big number on a screen you have to sell to access. Here's the standard advice. Invest for total return. Growth stocks provide better returns. Dividends are tax inefficient. All technically true if you're 25 with 40 years to compound. Completely wrong if you're 45 with 20 years until you need to actually live off this money. The difference is simple. Growth stocks go up in value, hopefully, but they don't pay you anything unless you sell them. Dividend stocks pay you cash quarterly, whether the stock price goes up, down, or sideways. At 25, who cares? Reinvest everything. At 55, approaching retirement, that cash income is literally what lets you eat without destroying your principal. Here's why this matters more than advisors admit. In retirement, you need income. Consistent, reliable, predictable income. Not my portfolio went up 8% this year, so I'll sell some shares. Because what happens when your portfolio drops 30%? You're forced to sell shares at depressed prices to generate income, locking in losses and accelerating the death of your portfolio. But dividend stocks? They keep paying regardless of the stock price. Market crashes 40%? Your dividend aristocrats, companies with 25+ years of consecutive dividend increases, rarely cut dividends. Your income keeps flowing even when your account balance looks terrifying. The math: $500,000 in growth stocks returning 8% annually gives you $40,000 in paper gains. To access it, you sell shares. Market crashes right when you retire? You're selling shares at terrible prices to generate income, destroying your future. $500,000 in dividend stocks, yielding 3.5%, pays you $17,500 in actual cash annually without selling anything. Market crashes 40%? Your account shows $300,000, but you're still collecting roughly $10,500 in dividends because companies didn't cut them. You never sold low. You waited out the crash, living on dividends. Account recovers, you're fine. What advisors won't tell you: dividend-focused portfolios generate fewer fees, less trading, less active management, less justification for their 1% annual fee. A boring portfolio of dividend aristocrats doesn't need much managing, so they push growth stocks and total return strategies that require more involvement and fees. The strategy after 40: shift your portfolio toward dividend aristocrats. Companies that have raised dividends for 25+ consecutive years. Coca-Cola, Johnson & Johnson, Procter & Gamble, and 3M. These boring companies pay you reliably and increase payments over time. Build your portfolio so dividends cover 50 to 70% of your retirement income needs. Social Security covers the rest. Now you can weather any market because you're not forced to sell during crashes. The income keeps flowing, the principal stays invested, and you sleep peacefully. Let me show you real numbers. Investor at 45 shifts $300,000 toward dividend-paying stocks, contributes another $200,000 over 20 years. At 65, the portfolio is worth $600 and generates $21,000 annually in dividends at 3.5% yield. Combined with a $24,000 annual Social Security, that's $45,000 total income. They never touch the $600,000 principal. It keeps growing. Dividends keep increasing. Market volatility becomes noise because income is secure. Compared to a growth stock investor who must sell 4% of the portfolio annually for income. Market drops 40% early in retirement. They're selling at terrible prices. Portfolio depletes faster. 10 years later, one investor still has 600 cal plus growing. The other is watching the principal evaporate. Growth builds wealth. Dividends fund life. After 40, you need both, but income becomes the priority. The stock that pays you is worth more than the stock that might go up. Dividends create reliable income. But Truth 5 reveals the expense that will destroy that income if you don't plan for it now. Truth number 5 is the retirement destroyer nobody wants to talk about because it's depressing and complicated. Healthcare costs will eat your retirement alive if you don't plan for them now. And financial advisors massively underestimate this because it doesn't fit their optimistic projections. Here's the number that should terrify you. The average couple retiring today needs $315,000 just for healthcare costs in retirement. That's not total retirement expenses. That's just healthcare, separate from housing, food, travel, and living. And most people have $0 specifically allocated for this. Let's break down why this destroys retirements. Medicare isn't free. Shocking, right? You've been paying Medicare taxes your whole life, and it's still not free when you need it. Medicare Part B costs $174 monthly per person. That's $4,200 annually for a couple, just for basic coverage. But Part B has gaps, so you need a Medigap supplemental plan, $200 to $400 monthly per person, plus Part D for prescriptions, $50 to $100 monthly. Added up, $800 to $1,200 monthly for a couple just for insurance premiums. That's $9,600 to $14,400 annually before you've seen a single doctor or filled one prescription. Then you've got deductibles, copays, and the big one nobody mentions. Dental and vision aren't covered by Medicare at all. Need new dentures at 70? $3,000 to $5,000 out of pocket. Cataract surgery? Hope you've got $2,500 per eye saved. But here's the crisis window that kills early retirement dreams. Ages 60 to 65. If you retire before 65, you don't have Medicare yet. Private insurance for a couple in their early 60s? $1,500 to $2,500 monthly. That's $18,000 to $30,000 annually. 5 years of this bridge coverage can cost $90,000 to $150,000. This is why people work jobs they hate until 65. They're imprisoned by healthcare costs. And the nightmare scenario, long-term care. Nursing home costs average $100,000 plus annually. Medicare doesn't cover it. Most people need it eventually. One spouse in nursing care for 3 years can obliterate $300,000 in retirement savings. Wipes out everything. What financial advisors won't emphasize enough. Max out your health savings account, HSA, right now if you have a high-deductible health plan. This is the most tax-advantaged account that exists. Triple tax benefit. You deduct contributions, lowers taxable income now. It grows tax-free, like a Roth. You withdraw tax-free for qualified medical expenses at any age. After 65, you can withdraw for anything and just pay ordinary income tax like a traditional IRA, but without penalties. The limits: $4,150 individual, $8,003 family annually, 2024. Invest it like a retirement account. Don't spend it on today's medical expenses. Pay those out of pocket and let the HSA grow. The math: max family contribution for 20 years, age 45 to 65, equals $166,000 contributed. With conservative 5% growth, you're looking at $275,000 plus by 65. That entire amount can cover Medicare premiums, supplements, prescriptions, dental, vision, long-term care, all tax-free. Let me show you the difference. Couple A maxed HSA from 45 to 65. Contributed $8,300 annually, invested it conservatively. At 65, they have $240,000 in an HSA. Their healthcare costs in retirement are completely covered with tax-free money. They sleep peacefully. Couple B didn't prioritize HSA. At 65, they're paying $1,200 monthly, $14,400 annually for healthcare from their retirement savings. That's $14,400 getting taxed as income, plus the actual cost. Over 20 years of retirement, that's $288,000 in after-tax money for healthcare expenses that could have been tax-free. Healthcare will cost more than your mortgage in retirement. Plan for it aggressively now, or watch it devour your savings later when you're too old to do anything about it. Healthcare planning protects the downside. But Truth 6 shows how to maximize the upside with a weapon most people ignore. Truth number 6 is the advantage hiding in plain sight that advisors mention but don't emphasize urgently enough. The moment you turn 50, you get extra contribution room to retirement accounts called catch-up contributions. And if you're not maxing these out every single year, you're leaving massive amounts of money on the table. Here are the numbers. Regular 401k contribution limit is $23,000, 2024. At age 50 plus, you get an extra $7,500 for a total of $3,500 annually. For IRAs, the regular limit is $7,000. Catch-up adds $1,000 for a total of $8,000. That extra $7,500 in 401k doesn't sound life-changing until you do the math over 15 years. $7,500 annually for 15 years, ages 50 to 65, equals $112,500 in extra contributions. With modest 6% returns, that grows to roughly $174,000 by age 65. That's nearly $175,000 you wouldn't have without using catch-up contributions. That's not a bonus. That's the difference between a comfortable retirement and struggling. What advisors don't emphasize enough, this is use it or lose it every single year. You can't go back and contribute for the years you skipped. Miss age 50? You permanently lost that year's $7,500 catch-up. Miss 5 years? You've permanently abandoned $37,500 in contributions, plus all the growth it would have generated. That's real money vanishing because you didn't get around to it. The urgency is critical. You have exactly 15 years of catch-up eligibility, ages 50 to 65. That window closes. After 65, there's no retirement account catch-up. It's over. This is your last chance to aggressively fund retirement with tax-advantaged contributions. The priority shift this should trigger. If you're 50 plus, maxing catch-up contributions should be priority number one, before new cars, before expensive vacations, before upgrading your house. This is your redemption arc. This is how you go from "I'm behind" to "I'm going to be okay." The strategy is intensity. Age 50 hits, immediately increase 401k contribution to max, including catch-up. Adjust lifestyle to accommodate if needed. It's a temporary sacrifice for permanent security. 15 years of intensity create a lifetime of comfort. Let me show you the real impact. Woman age 50 with $150,000 saved, felt behind, panicked, but she got aggressive. Maxed her 401k with catch-up contributions, $30,500 annually, for the next 15 years. Her employer matched 50% up to 6% of her salary, $4,000 annually. She contributed $30,500, and the employer added $4,000, for a total of $34,500 going in each year. After 15 years, the original $150,000 grew to $360,000. New contributions plus match $570,500 grew to $690,000 with compound growth. Total at 65, $1.05 million. She went from behind at 50 to a millionaire at 65 purely through aggressive catch-up contributions and employer match. Without catch-ups, contributing just the regular limit of $23,000, she would have hit roughly $750,000. Still good, but $300,000 less. That catch-up contribution difference alone added over $250,000 to her retirement. Meanwhile, her colleague, who couldn't afford to max out catch-ups, retired with $400,000. Not broke, but significantly less comfortable. Same age, same job, same employer match structure. One prioritized catch-ups ruthlessly, one made excuses. Catch-up contributions are your redemption arc. They're the government saying you get one more chance to fix this. Use every dollar of that room every year without exception. No excuses. This window closes at 65 and never reopens. Catch-up contributions maximize what you can save. But Truth 7 challenges everything you've been told about how to save it. Truth number 7 is the most controversial and challenges the advice financial advisors have been giving for decades. Maxing out your traditional 401k for the tax deduction might be a mistake after 40. Roth 401k contributions, where you pay taxes now, could actually be better for your retirement. And advisors won't push this hard because it directly conflicts with their business model. Here's the standard advice you've heard forever. Max your traditional 401k. Get the tax deduction. Lower your taxable income now. You'll be in a lower tax bracket in retirement anyway. Financial advisors love this advice because bigger traditional account balances mean bigger assets under management, which means bigger fees for them. But here's what they're not telling you. That advice assumes tax rates stay the same or go down. Current tax rates are historically low and likely to rise. It also assumes you'll have less income in retirement. But with Social Security, pensions, if you have one, and required minimum distributions forcing you to withdraw whether you want to or not, you might actually be in a higher tax bracket in retirement. The RMD problem is the trap nobody explains clearly. At age 73, the government forces you to start withdrawing a percentage of your traditional retirement accounts. These required minimum distributions are calculated to deplete your account by average life expectancy. You have no choice. You must withdraw. Every dollar withdrawn is taxable income. Here's where it gets painful. Those forced withdrawals can push you into a higher tax bracket than you expected. If you've got $800,000 in traditional accounts at 73, your RMD is roughly $30,000 annually. Add Social Security of $30,000. You're already at $60,000 taxable income before taking a single voluntary withdrawal. And if your Social Security gets taxed because your income is too high, you're paying taxes on money you're taxed on. It's a mess. The Roth 401k alternative flips this completely. You contribute after-tax dollars now, no deduction. It grows tax-free. It comes out tax-free in retirement. And the killer advantage, no RMDs ever. You're never forced to withdraw. You can leave it growing tax-free for decades if you want. You can pass it to heirs completely tax-free. When does Roth win? After 40. If you believe tax rates will be higher in the future, historically likely. If you have substantial retirement income from other sources. If you want tax diversification and control. If you want to leave a tax-free inheritance instead of a tax bomb for your kids. Here's the truth advisors won't say directly. Traditional 401k benefits them. Bigger account balances equals bigger fees. Roth contributions mean you're paying taxes up front, which reduces the amount going into accounts they manage. It's better for you long-term, but it reduces their fee base. So they mention Roth politely and move on to pushing traditional contributions. The smart strategy? Split your contributions, do some traditional, some Roth, create tax diversification. Then in retirement, you have flexibility. Withdraw from traditional in low-income years, withdraw from Roth in high-income years. You control your tax bracket instead of RMDs controlling you. Let me show you the tale of two 55-year-olds. Man A contributes to a traditional 401k for 10 years, gets tax deductions, and builds $400,000 by 65. Retirement. Every withdrawal is taxed. RMDs at 73 force 15,000 plus annual withdrawals he doesn't need, pushing him into a higher bracket. Lifetime taxes on withdrawals, $80,000, $100,000. Man B switches to Roth 401k at 55, pays taxes on contributions for 10 years, painful, and builds $350,000 by 65. Retirement. Zero taxes on withdrawals, no RMDs forcing income, total lifetime taxes, dollars. He started with less and ended with more usable money because of the tax-free status. Tax deduction today feels good. Tax-free forever is good. After 40, you're likely in peak earnings, can absorb the tax hit, and benefit massively from Roth advantages. Question everything you've been told about traditional contributions. So here's what you need to understand as we close this. 7 truths financial advisors won't emphasize. Different time horizon demands different risks. Roth conversions beat future taxes. A house is a shelter, not a retirement plan. Dividends generate income you'll need. Healthcare costs will destroy you without planning. Catch-up contributions are use it or lose it wealth. A Roth 401k might beat a traditional after 40. Drop a number 1 to 7. Which truth changes your strategy most? And if you're thinking, this contradicts everything I've heard, how do I actually implement this without making expensive mistakes? The next video walks through the exact portfolio allocation, contribution strategy, and step-by-step action plan specifically for investors over 40. Hit subscribe if you want that detailed breakdown. Share this with someone over 40 still following advice designed for 25-year-olds. You're not behind. You're playing a different game now with different rules. The strategies that work at 25 fail at 45. Start playing by the right rules for your timeline. Conventional wisdom works for conventional timelines. Yours isn't conventional anymore. We'll build your age-appropriate strategy next time.